All right, thanks very much, everyone. So today we're going to be presenting the October 2022 monthly market economic update. And quite obviously there's been a fair bit of stuff happening in markets over the course of the last month. But before we get into that, I'd like to welcome Shane onto the monthly update.
Nice to be here.
Good to have
Hopefully
you.
it'll be nicer next time when we're talking about better markets.
Because when markets go up, that's right.
Yeah.
It's been a joyous ride. All right, so we might just skip through to what is GDP growth. So this is a fairly familiar story, and for those viewers that have been listening over the course of the last month, we've seen, as you see in here, we've seen inflation really, we've seen GDP growth really take off post-COVID, and now we've obviously seen it falling back. And this particular chart is around the world. If we have a look at the next slide, which is just in Australia, it's a fairly similar story. So the GDP numbers have been looking okay, but of course, which is what we'll go into in a minute, there's some issues around inflation in Australia as well. We've got some house price data, which I suppose here reflects housing prices really taking off from 92 to 2022, supported by increasing levels of household debt as well. So that's again been a fairly consistent theme. And we see, but certainly over the course of the last 9 months since we've started to see rate rises, this chart here is really showing a reduction in prices. So prices that really are starting to fall as a result of increasing inflation.
And arguably there's a bit of hand-in-hand component there with GDP growth as well, is that money coming out of households into interest rates and servicing of debt will come straight out of those GDP numbers.
That's right. Spot on.
Yeah.
Flicking through to inflation now. Do you guys want to talk through inflation numbers?
They're ugly, aren't they, really? It's the only way to describe it. You see the chart like this and you look at the long-term average and you can't help but raise an eyebrow. And we feel it, don't we? Every day we go to the petrol bowser or the supermarket, and there's been so many inputs towards inflation, which I think it's probably unprecedented in history in terms of how many inputs there are, combining to inflation here. And I think this is the sort of dichotomy today about controlling demand with a very blunt instrument of interest rates versus this supply issue that we seemingly can't overcome. And kind of this disconnect that's present, I think we're going to continue to see this inflationary number bounce up and down until we kind of see some green shoots somewhere or another, demand or the supply side.
Relative to the rest of the world, we haven't seen inflation in Australia being as significant. But that's not to say it's not yet to come.
I was going to say, also it doesn't change the experience of people.
Yeah.
One of the, the interesting discussions that I've been having with clients recently is that there's and I think this is just maybe it's a human behavioural trait, is that whatever is happening at this point now is how it's going to be forever.
Yeah.
And
it's linear. That linear outcome.
Yeah.
It's never that way, is it?
And so if you come back to, do you want to flip back a couple of slides back to
say when?
Was it it must have been GDP, the house price growth, sorry, that's what I was thinking whilst you were talking. So that middle chart, I suppose, where housing prices have gone up and then come back down again, there's something in economics known as like the wealth effect, and it's basically where, and it's typically aligned to, especially here in Australia with house prices. When house prices go up, everyone feels wealthier, so their inherent behaviour is to then spend more. And obviously, conversely, when prices are falling, people feel poorer and typically spend less. So I guess one of the things that I've been talking about consistently with clients is that there's a lag effect on all of this. So a lag effect with interest rates rising, a lag effect with the wealth effect, to double use the word, but then also coming back to that chart around things kind of staying the same forever. Is that it's hard. Like we all absolutely understand and empathise with it, but it doesn't necessarily mean that it's going to be this way forever.
No.
Everything is going into changing that.
No, there is constant change, isn't there?
There's still a little bit of household savings to that point, Chris, as well. That kind of, we wind back a year ago, I would probably, to your point about household values, not only that, there was so much stimulus around the last couple of years prior. And you'd probably almost look at balance sheets globally and think probably the healthiest they may have ever been this time last year. So that brings that confidence, and then you euphoric spend post-COVID. You can see how quickly this is sort of caught up. And I do agree. It's sort of at the point of now. It doesn't always stay that way, does it?
Yeah, correct. Yeah, and it's interesting you say that in terms of. I was listening to some a podcast the other day in terms of the RBA stability report. I think that came out, basically saying that from the surveying, I don't know what their sample size is like, but they estimate that people typically have about 6 months left in terms of ability to service mortgage and savings, and then we're going to, I guess, come off a cliff essentially. And then, what did I say to you? Was it 55% of all mortgages in the country are currently under fixed rate environment?
Which I thought was high. That seems very high. But I mean, they've got the data, right? So
correct. Yes. But then they will end at the end of this calendar year. They'll be up or they'll come off fixed rates onto variable rates, and that's, I think, as it stands today, on the average fixed rate, it's a 40% increase in 40% increase in rate. So that's going to have a significant impact too in terms of people's spare available surplus or profit, I suppose.
There were fixed rates we saw 1, 2, 3 years at 1.8, 1.9. There was some very low rates, and now you're walking into 5. So that's a significant difference, and that I suppose, I've said this a couple of times. So you think about investment properties or properties in general. The average price of a house in Australia is $800,000. If you've got a $700,000 mortgage and you're paying 2%, you're paying $14,000 a year in interest. Now you're paying 28, and you might be paying 42. So that's why monetary policy is so effective, right? Because you just don't. There's just not that spare money in the economy anymore.
Yeah, correct.
I think also too about interest rates. I mean, it's amazing how the media always portrays raising of interest rates as a negative component, and there are certainly parts of it which, to your point there, Cam, that hurt, right? But there's also a lot of positives on the other side of higher interest rates, and I think the dilemma we face today as investors is that this volatility, whilst we're going through this transitionary, from zero interest rates to a higher interest rate environment, is painful because it's so volatile.
Yeah.
But I think when we get to that journey where interest rates potentially plateau off and settle down, I think it's a better space for investors who have got capital. Those who have got servicing of debt, adjust and to live within their means from that perspective. And arguably we get to a more sustainable place where asset valuations aren't just going, crazy every single month because interest rates were fueling it at zero. So it depends on which lens you look at it, I think, from an interest rate point of view.
Absolutely.
As to how it plays out.
While you're talking there, Shane, it just rings in my head about the value of having stepping back and taking a longer term view, and then also just around, we obviously bang on about this, but the value, I guess, of that long term piece where you're not trying to make decisions in a narrow view of, oh my God, this is a situation over the next 3 months. What massive decisions am I going to make with my wealth position because of the way it is now? When we're trying to trying to obviously explain to everyone what's going on, but then also having a greater view, and to your point, saying price stability, better ability for us to achieve greater levels of return in the long run. That's clearly a positive, but in the right now, it just feels really horrible. So it's really important to
longer term lens.
Yeah, absolutely.
These are our CPI numbers around the world, which I guess we've sort of been through a little bit. Importantly, what we're looking at here is the question is how far will cash rates go, and the market, so the bond market, is predicting, say in the US Federal Reserve, it might go. This is where we are now, about 3.5. It's predicting it might get just around about 4.75. So that's what the market's predicting, and then it's predicting it that will fall off. And you'll see that that's the same in the Bank of England, even with the issues that they've got in the UK at the moment.
Over there,
ECB and Bank of Japan. Okay.
I think going add to that, that's an important slide. So I really like that chart because it sort of, I think, helps explain some of the priced position that we find ourselves today. The market's pricing in these sort of numbers, right? So if you get these, and this is probably why we're seeing such sensitivity to positive and negative news.
Yep.
Anything that oscillates on either side of that chart there, in the last 2 weeks have been crazy, really. I mean, a couple of days we had 5% positive within 2 days, and all unwound within a week because news that sat on either side of that interest rate forecast with the US rates. So, until we see some stability, it's probably these days of volatility probably the norm.
Very likely to continue, and that's really that's the story of the last 9 months. Like the VIX, which is the measure of volatility, that continues to spike, and it's up 32 again now. So that it's just how it is for the time being, and your statement around taking a longer term approach, I think, is really valid in that instance, because
I think you're going to come up to it. Interestingly, is that, and to Shane's point about sensitivity, when like that week where we had the 5 or 6% in a couple of days, there wasn't much positivity. It was just a lack of bad news, essentially. And so,
that's right.
When this, I guess, when all of the rate rising, I guess, has its effect, the reversal, I feel personally, is going to be pretty swift. Not in totality. Like, we're not going to recover all of it, in a week. But I think that the reversal is going to be rapid.
So this next chart is going to speak to, I guess, the history of the bond market. Now, of course, most of our clients' defensive portfolios are invested in bonds, be that Australian government bonds or corporate bonds, or global bonds, US government bonds and the like. And I guess what we've seen over the course of the last, since December really, has been a reduction in capital values of those bonds. And this chart just speaks to that level of reduction, in the sense that so when the last bond market crash was in 94, all right, so that's how many years ago?
28.
Thank you. I was getting there. And that was considered a fairly significant event, and we saw a -6 on the Australian market. The global credit index was back in, actually I haven't got it there, but it was about, I think global credit was -10 or something like that. What we've seen this latest time has been -12s and -15s.
Yeah.
So it's really just the bond market repricing risk, and I guess one of the key characteristics that we really wanted to talk through is the risk is interest rate risk, essentially. It's not the fact that we think that the Australian government bonds aren't going to be worth what they're worth in 10 years' time, or the market doesn't think that, right?
Yeah, it's a really good point, isn't it? Because people see assets go down and they instantly think that must be something underpinning that, which makes those assets worth less than they were yesterday. But this is sensitivity around interest rates, right? But the underlying holders or issuers of those bonds are still very stable.
That's right. It's Australian government bonds, it's corporate bonds from CBA and US government bonds. So as long as you hold them through to maturity, I think
you're okay.
99 times out of 100 or even more, you're going to get your capital back.
Yeah, and what it also says is that forward expected returns.
Nice segue, Chris.
Are significantly higher.
So this chart here is a characteristic of our current fixed income part of the portfolio, which doesn't make up all of our clients' defensive aspects, but I guess what we're seeing here is the yield to maturity today on that is about 4.5%. So yield to maturity is the expected return that clients will receive over the course of the next, the duration of the portfolio,
8 years,
which is 4 years, just a tick above 4 years. So you're looking at those numbers back in December, and they would have been...
Well, we're looking at like 0.98 for 10 years.
Yeah.
Like that was, and then obviously prices have dropped, and assuming your issuer doesn't fall over, or the Australian government's not going to fall over, you're going to get the same rate of income return. And then
that's right. So jumping into the next slide, this is some of the different areas of fixed income that you can get or have access to, and obviously treasuries are showing a yield of 2.4, but then as you go further out the risk spectrum, I suppose, in fixed income, you're getting 4s and 5s and 6s and 7s, right? So those yields have really changed.
Yep.
And you look at it through the lens of, say, let's use a retiree as an example in this instance. You know, the capital devaluation has been challenging in the last few months, and it's probably been frustrating because diversification as a principle has sort of failed in some respects this time around because of these factors we're talking about here and defensive side. However, the income now that's coming out of these is much healthier and it will support income payments moving forward, provided that we can hold on to the bonds until duration.
That's right.
As we talked about there. So, you know, there is some positive in a bad outcome that is present in these numbers, I feel.
Yeah, definitely. And that speaks to your comment before about, you know, interest rate rises not necessarily being a bad thing, whilst, you know, it's hurt for the last 12 months, absolutely. What that means for retiree clients, you know, just, well, for the moment, higher term deposit rates, like, I don't know, what's a 12-month TD running at the moment? It's like
3.5.
Yeah. So it's significantly better than December last year, where you're lucky if you were getting 0.75%. So, you know, it's your point before about being in a transition point is absolutely bang on. It's just acknowledge that it's hard.
Yeah, it is hard. Right. Yeah, that's
fair point. Okay. Moving on to equity market performance. Who wants to walk us through this one?
Well, it's been interesting, hasn't it, equity market performance? And I think it's safe to say, I mean, on all asset fronts, when we see valuations come down, and particularly bond markets and now equity markets coming down at the same, if not worse, rates, human nature is such that we seek high ground, right? It's a very common human characteristic that we all have, be it in finances or be it health, whatever it is, we seek high ground. And sometimes, to your point before, Chris, taking that point back and think, you know what, this is ugly, but are we going to be okay in all this? And these numbers here are certainly ugly. But, you know, you showed some numbers before, Cam, about GDP. You know, GDP has been pretty healthy. So we're starting from a very strong economic backdrop. And I've been asked a few times, you know, are we seeing conditions similar to the financial crisis? And, you know, there's parts we've seen the numbers in the equity markets coming down. You think, oh, there's snippets of that. But back then, compared to today, the economy back then was broken.
Yeah, absolutely.
Whereas today, the economy has been stimulated and fueled with this massive growth. And we're almost now paying the price for too much stimulus.
That's
exactly right. So it's, I think, whilst the equity numbers are horrible, the good news in it, I think, is that we're starting from a pretty strong economic base.
Phenomenal.
And if we can see businesses hold on through the next 6 to 12 months in terms of earnings and earnings growth or earnings outlook being okay, then these valuations will level out and potentially, you know, sort of snap back at some point.
Yeah, for sure. Well, exactly what happened during the financial crisis, right? We got to a bottom and it rocketed. And that was like a systemic issue to the whole financial system, potentially. This is a very different story. Yeah.
It is a very different story. And I suppose to that note, this is just around market timing. So it's essentially telling us and telling clients, and this is history from 1990 onwards, that you just have to stay in the market. The best 20 trading days closely follow the worst 20 trading days, which is what you can see in these spikes here. So there's no panacea. I wish we were able to pick and time markets, but there's no Nostradamuses here.
No, not at all.
I was talking to someone earlier today and I sort of reflected on the current conditions. I said, well, it's sort of a market, you don't really want to be invested in it, but you don't really want to not be invested in it either because this very chart speaks to that. And we've seen some of these traits over the last 2 weeks, right? We talked before about those numbers, a couple of big days, a couple of ordinary days, and we're seeing this kind of level of, you know, movement play out as we speak.
Yeah, exactly. That probably speaks to the next slide too, you know, so this is an example of being completely invested in the US equity market from 1928 to 2021 and your return is 6.2% invested the whole time. You miss the best 10 days, you're back to 5, you miss the best 20, you're back to 4, and you miss the best 30 days, you're back to 3. So, long term.
It's quite remarkable, those stats, when you think about it in reality. It's a very interesting set of numbers.
speaks to, and again, this is biased, right? But in terms of our approach has always been evidence-based.
Yep,
And
that's right.
To Shane's point about we always seek higher ground, that's an emotional hook, or I guess an emotional response that people want to, and to be honest, I probably feel like I react to it too, but I think I have enough, experience doing this to sort of say, to override that mentally, in that the evidence shows us that not reacting to those emotional pulls has a better financial outcome. So
that's right.
I think it's just try and, as we keep saying, it's really hard at the moment, but try and keep that in mind. The philosophy is evidence-based. So we're not just saying, just hold on, she'll be right. There's a reason why we're why we're saying that.
Exactly.
Yeah, I think that's a good point, because that sort of thing, hold on and be okay.
Yep.
It can be a bit flippant, couldn't it?
Correct.
But it's certainly it's not without its empathy in terms of today is really difficult.
Yep.
To stomach and see balance sheets sort of suffer.
Yep.
But I really enjoyed that point about evidence based there, because when you reflect on this data and you take the pure emotion out of your decision making, I think we all concluded an outcome where we know what to do intuitively, but it's just a hard journey to ride.
Well, I guess based on those numbers and purely around the evidence supporting it, why would you ever not be invested?
Yeah.
Because you end up with half the return.
Yeah. Yeah.
All right. And then I guess this is just a final one around market timing again. We've seen over most periods, quite a long period, the bull years significantly outweigh the bear years. Back in from 86 through to 2007, 1,200% return. And then a down at that period of time, which was the GFC. It's a very significant time, minus 48. This is US equities. So, all right. Any other items we want to bring up as part of the October
Not really.
update?
Well, look, the only thing I've kind of been saying to clients is that, and we've come through some of it today, is that there'll come a point where all of the interest rate rises will have an effect.
Yeah.
And it's not if, it's when. So, I just keep hearing from clients acknowledge it's hard. It's been a long 12 months. So, I know it feels like we're just not flippantly saying hold on, but trust the process, trust the experience. It will turn.
Absolutely.
The only thing also around there to that point as well is that what we see in the news all the time is this focus on interest rates and sort of controlling demand. And our central banks only have that one tool to use, is to control demand. And whilst I'll never speculate on what China will do with lockdowns or what Putin will do with invading Ukraine, they are contributors to this situation that we've got today. And at some stage, they too will get better. And that too will help enormously with the sort of reversal of this inflationary issue, and then the reversal or this levelling out of this interest rate cycle. But what we keep seeing now is our central banks are doing what they're governed to do, and they're doing it the only way they can do it today. But there are other sides that will, in time, help out with the situation.
Spot on. General advice warning. That was all general advice. Obviously, if you need specific advice, you will come and see us individually. All right. Thanks very much, everyone. Really appreciate you making it to the end of the video.
Definitely.
And thanks, Shane, for joining us.
Nice. We look forward to many more of these to come.
Yeah,
it's very good. All right. Thanks, everyone.
Thanks, everyone.